Target is placed at the next key resistance level. Now watch what happens next. As you can see, the market pushes higher and reaches the target exactly as expected. Now let's move to another chart example. This is the Australian dollar versus the Swiss franc on the 5-minute chart. As you can see, the market is trading below the 200 exponential moving average. This tells us that the overall trend is bearish on both the higher time frame and the 5-minute chart. Now look at this area here. The market reacts from this zone and moves higher, creating a clear support level where buyers previously stepped into the market. But now, pay close attention to what happens next. As you can see, the market breaks strongly below the support level, signaling that sellers are gaining control. Once the breakout happens, the old support level now has the potential to become new resistance. Now look at the retracement. The market pulls back toward the broken support level, and as soon as price reaches this area, it gets rejected and forms a clear doji candlestick pattern. So what does this doji tell us in this context? It tells us that buyers are struggling to push the market higher and that the market is entering a temporary state of equilibrium after the pullback. In a bearish trend, this hesitation near a broken support level often signals weakness from buyers and the possible beginning of another impulsive move to the downside. And that gives us our trading setup. The entry is placed at the close of the doji candle. The stop loss is placed above the retracement high to protect the trade from normal market fluctuations. And the target is placed at the next key support level, always aiming for a minimum 2-to-1 reward to risk ratio. Now watch what happens next. As you can see, the market drops lower and reaches the target exactly as expected. Now pay close attention to this next chart example. This is another 5-minute chart example of the Australian dollar versus the Swiss franc. As you can see, the market was initially trending higher and eventually formed a clear triple top pattern, which is a well-known reversal pattern in technical analysis. Here is the first top, the second top, and the third top. Together, these highs create a strong resistance level where sellers repeatedly stepped into the market. After forming the triple top pattern, the market starts reversing lower. However, notice that price is still trading above the 200 exponential moving average. This is very important because it tells us that, despite the short-term pullback, the higher time frame trend is still bullish. Now look at what happens next. The market regains momentum, breaks above the old resistance level, and turns that resistance into new support. But instead of entering immediately after the breakout, we wait for confirmation. As you can see, price retraces back toward the broken level, reacts from it, and forms a strong, bullish engulfing candlestick pattern. This is a powerful signal because it suggests that buyers are stepping